Welcome to Pressure Points. I'm Gene Munster from Deepwater Asset Management. Our topic tonight is Tesla's September quarter earnings. The pressure point is related to profitability. This is a bonus episode. We're also going to cover Cybertruck, FSD, and the bigger picture related to Tesla, but want to start with the all-important margin category. And just for the headline here is, in their prepared remarks, Tesla used the word challenging twice. In the June quarter, they never mentioned the word challenging, and I think that's the context related to margins. So previewing this, we talked about the all-important metric was, of course, auto gross margins excluding credits. That came in at 16.3%. The street estimates were 17.6%, and it was 29% about a year and a half ago. And so that profitability has been declining, in part because of lowering prices. Also, volumes have declined, so there's a efficiency piece that has been pressuring margins. And the key question that, of course, investors are asking is, for Tesla to be a tech company, they need to have higher margins than traditional automakers. And so, as I mentioned, the gross margin, 16.3%, that would compare to other automakers right around 10, 11%. And so it still is higher, but that gap has closed significantly over the past year and a half, which begs the question for investors, when are these margins going to improve? And on the call, there was some optimism initially after the report of the quarter that they would give some optimism related to improving margins, but instead they really tamped down the expectations and talked about the ramp of Cybertruck, which we'll talk about in a second, and some of the investments related to that, when that will reach efficient scale, and also talked about just a challenging macro environment that can dampen overall demand. And even though they didn't give explicit guidance for margin for the December quarter, my sense is that it's going to be flattish from where it was in September in that 16.5% area, and probably won't see a move materially higher for a year plus until they start to see more scale related to Cybertruck. And so when that reality kind of sunk in, shares in the aftermarket were trading down 1%, and then they kind of drifted down 4 or 5%. I would expect in trading on Thursday that would continue to decline. The pressure would continue to be on shares of Tesla. And so the one-liner on margins is they were lower than expected, and they're probably going to be in this range for the next year plus. Second topic is related to Cybertruck. They did give a release date that is November 30th and said that it's going to take about a year and a half for volumes to ramp up to 250,000. They did mention that they have 1 million pre-orders. That's an impressive number. Of those, I estimate half or 75% are real buyers, which means that in about a year to 2 years, Cybertruck should exceed the king of light trucks in the U.S., that, of course, the F-150, in terms of total volume. There is going to be a question about, in year 3 and 4, does Cybertruck continue to outpace the F-150? Usually what happens, you'll have a burst in demand as the pre-orders get filled. This is what happened with the Model 3, and then you see kind of a pullback. But safe to say is that consumer interest in the Cybertruck is significant, and that should pose a challenge to all the other truck makers that tend to be some of their higher margin business. Elon had a lot of colorful language when it came to Cybertruck. He mentioned that when you build a product, a once-in-a-lifetime product, you dig your own grave when it comes to profitability and reaching scale, and just how difficult of a vehicle this is to ramp production. And so I think that the light will go on with investors as these start to make their way into the market beginning next year. And I think that there will be some optimism, and that this should have a positive impact on overall units, although it will pressure margins. And so patience is a virtue when it comes to Cybertruck. I think it will deliver on the hype and ultimately be one of the leading light truck vehicles in the U.S. Next is related to FSD. This, of course, is the holy grail in terms of unlocking margin opportunity, but also has been the boy that's cried wolf for the past 6 years in terms of when we're close to FSD. The number of miles that were driven was just over 500 million, call it 520. That's up from 300 million at the end of the June quarter and 150 million. When Tesla reported their June quarter, they talked about this exponential ramp they're going to see in miles driven. So that left me with a belief that we're going to have over 600 million miles driven. Basically, it would double again from the previous quarter. And we just fell a little bit below that, which was a disappointment. Elon was quick to remind people that essentially we'll have a chat GPT type of moment when it comes to AI as more model training is going on. We should see the effectiveness start to break out, even though it will be a breakout and then plateau and then breakout again. And the net of this is that we still don't know when we're going to see mainstream FSD, but it's likely in the next 2 to 5 years. And so eventually Tesla's going to get there. I think they're going to be one of the first ones there. And I think this is going to prove to be an important part of the investment case. And chalk this also in the category of patience is a virtue. But they do have a good lead when it comes to the miles driven. And the last piece is the bigger picture. And when I think about the Tesla investment case, this margin is an important piece, but it doesn't tell the whole story. I think that the bigger story is the addressable market. The car market is a big market. Depending on how many vehicles, 70 to 85 million, somewhere in that range. This is a $2.1 to $2.6 trillion a year market. It puts it about 4 times as big as the smartphone market. So this is something that you can build a huge business around. And Tesla next year is probably going to be about 130 billion in revenue. And so there's just a massive opportunity for them to be a leader and to capitalize on what is an inevitable shift from gas to electric. It might take longer because we're having this lull in the consumer. However, it is something that is going to be inevitable that we're going to go to electrification. So I think that is something that gets me excited, is just the size of the electric addressable market. And then on top of that, eventually we're going to get to autonomy, and that's going to unlock some value. And the last piece of it, I continue to believe traditional auto is in a tight spot. And more recently, we've seen some push outs from General Motors this week talking about their Orion all-electric light truck manufacturing plant that being pushed out for a year. It was supposed to be producing vehicles in 2024. They've now moved that to 2025. Also, GM postponed their analyst day, their investor day from November for a full year. They blamed the talks with the UWA as the reason for the push out, but seems pretty aggressive to push it out for a full year. I think it's a sign that these companies, whether it's Ford losing more money, GM pushing out some of the production, still trying to figure out what the path forward is with electrification, not to mention some of the structural changes they need to make on their cost structure with labor and in terms of their dealer networks and how they optimize those. So I still think the cards are stacked in favor of Tesla when you think about the bigger picture. And yes, this is a challenging period, but the winds of change are still at Tesla's back, and I think they will capitalize on that in the years to come. So on behalf of Pressure Points, Bonus Version, and Deepwater Asset Management, I'm Gene Munster. Bye for now.